My name is Jerry Salai. I'm a Chief Strategist at Tricio Investment Advisors. And for the week of 15 June 2026, we shine our spotlight on the Fed meeting. This is the first meeting where Fed Chair Warsh is in charge. He was appointed by Trump to lower rates. It's going to be very difficult for him to do that, though. As you can see, the yield curve has shifted. The orange is a year ago, green is 1 month ago, and the blue is current yields. The 1 month yield is trading around where the Fed funds range is, should be around between 3.5 and 375. The 2 year note yield should be there as well, but it isn't. It's been above 4% ever since the US war in Iran kicked off. It's one of those things where the market is expecting inflation to probably remain elevated for the next year or so. And the risk is, as the money markets have shown, that the Fed not only changes their bias from potential easing to neutral, but has to actually address market concerns that inflation will remain rampant and move to we have to hike if inflation remains above target. Keep in mind that the reason the Fed started lowering rates in 2024 was because the unemployment rate started rising. The unemployment rate is basically stuck in a range, 4.3, 4.6, and there is a slight risk it actually drops down to 4.2 or even 4% again. The Fed will tolerate low unemployment rates without having to raise rates. However, they can't tolerate inflation rising well above target. Everybody knows that the Fed has missed a 2% target for 5 years now. So right now we're getting inflation readings that are not just above the Fed's inflation target range, but well above it. And the risk is they push even higher. If that happens, then yes, the money markets might be bright and the Fed may actually have to raise rates before year end or early 2027. For this week, we're seeing a Fed Chair Warsh can get consensus to keep rates unchanged and to keep some sort of easing bias in place, which would please President Trump. There's a good chance that doesn't happen, and the Fed goes to a very neutral bias, seeing risk on both sides, easing or raising rates, but taking a wait and see attitude. And there's a slight risk that you see more dissension with more Fed members not just saying, look, we don't want the easing bias in the text, but we should actually be thinking about raising rates. Watch and wait. For further information on Tricio's research insights, please contact us at info@tricio-advisors.com. That's advisors with an L. And ask about our Ask a Buddy service, where we help our clients manage risk and build resilient portfolios.